Welcome to the Deep Dive. Today, we're plunging into a topic that, well, it might seem a bit accountants, only at first glance. But honestly, it's surprisingly complex and really, really key to understanding a company's actual financial health. We're talking about how things like bonds or shares get classified. Is it debt or is it equity?
Right. It sounds straightforward, maybe.
Yeah, but it's a real puzzle, and figuring it out is crucial if you're looking at a company's books.
And to help us get our heads around this, we're using some great material from a source called When Does Debt Seem to Be Equity.pdf. It really lays out why this is so tricky for, the people actually preparing the statements.
Okay.
And more importantly, why it matters so much for basically any company's financial picture. It's foundational stuff.
So our mission today, let's cut through the jargon, pull out the really important bits, and get a handle on what these decisions actually mean in the real world. We want you to have those aha moments when you look at financial reports. So let's dive in.
Let's do it.
So the source points out this core problem straight away. Yeah. Deciding if something's strictly debt or strictly equity. Not always easy.
Not at all.
Because so many instruments these days have features of both, right?
Yeah.
They're kind of hybrids, and that can mess up consistency in reporting.
Exactly. Financial chameleons, you could say. And that's where standards like IAS 32 financial instruments presentation come into play. Its whole purpose is trying to, bring some clarity.
Okay.
It defines financial assets, liabilities, and equity, and then tries to set out the basic rules for how they should show up on a balance sheet. Trying to get everyone singing from the same hymn sheet,
Right. Okay. So we know what the problem is, and IAS 32 is the rule book trying to sort it out. But let's get to the so what. Why does this classification matter so much? Like, what are the actual impacts for a company?
Oh, the impacts are huge. Huge. How an instrument is classified directly hits its gearing ratio.
That's the debt versus equity level, basically.
Well, exactly. How leveraged they are, it hits their reported earnings, and it can even affect their debt covenants.
Oh, those promises they make to lenders.
Precisely. Imagine you think you've issued equity, but oops, it gets classified as debt. Suddenly, your gearing ratio spikes. Maybe you breach a covenant. Getting new loans could become way harder or more expensive.
Wow.
Now, classifying something as equity can avoid those hits, sure, but sometimes existing shareholders don't like it if they feel their stake is being diluted. And it's super relevant when companies issue stuff to fund, say, buying another company.
So it really affects their ability to run the business and grow. Okay. And if it is classified as debt, what about the payments? Interest payments, for instance.
Right. If it's a liability, typically any payments interest usually get charged straight to earnings as an expense.
Which lowers profit.
Which lowers profit, exactly. And that can then knock on to how much cash they have available to pay dividends to their actual equity shareholders. Management really needs to get this right when they're weighing up how to raise money. A wrong call can really bite them later.
Okay, makes sense. Let's get back to basics then. What makes debt debt, according to the standard?
Okay, the absolute key feature of debt is that the issuer is obliged. They have a contractual obligation. They have to deliver either cash or another financial asset to the holder.
So it's a promise they can't back out of.
Exactly. It could be explicit, like paying interest and principal on a bond, or maybe indirect, but it has to be in the contract terms. The source uses the classic example, a bond that requires interest payments and redemption for cash. That's debt. Clear cut.
Right. And here's where it gets really interesting. Contrasting that with equity. What's the deal there?
Equity is basically the leftover bit. It's any contract that shows a residual interest in the company's assets after you take away all its liabilities.
The residual interest.
And the crucial difference. With equity, there's no contractual obligation for the company to hand over cash or another financial asset. None. And if it is settled, it might be settled using the company's own shares.
Like ordinary shares, right?
Okay.
Dividends are guaranteed.
Precisely. Payments like dividends. Totally up to the company. They can pay them, not pay them, cut them. It's their call. That's why they're equity. The company isn't obliged to give you your investment back. They have the unconditional right not to pay.
That's a really clear distinction. Obligation versus no obligation.
That's the heart of it. The source really hammers this home. The critical feature separating liability from equity is whether the issuer has that unconditional right to avoid delivering cash or another financial asset.
One conditional right to avoid. Okay.
And this obligation, it has to come from the instrument's terms itself. It's not about, the company really needs cash or they don't have enough profits right now to distribute. Those things don't cancel out a contractual promise if it exists.
So it's purely about the contract terms, not the company's current situation or intentions. Like what if they fully intend to pay but just can't? Market crash or something.
That's a great point, but according to the standard, no. Intentions don't change the contract. Financial difficulty doesn't change the contract. If the contract says there's an obligation, it's classified as debt, period. It's about the legal reality, not the economic hope or difficulty of the moment.
Okay, got it. Legal reality trumps intention. But the source also says it's not always that simple, right? Like preference shares.
Ah, yes. Sometimes the lines blur. For instance, preference shares that must convert into a fixed number of ordinary shares on a fixed date, or when something specific and certain happens, those are actually equity.
Even though there's a mandatory conversion, that feels a bit like an obligation.
It does seem counterintuitive, but it leads us to this really important concept, the fixed for fixed requirement.
For fixed, okay, what's that?
It means a contract is equity only if it's settled by the company swapping a fixed number of its own shares for a fixed amount of cash or another financial asset. Think of it like a very precise exchange rate, exactly this many shares for exactly this much cash. Fixed for fixed.
And if it's not fixed for fixed?
The moment there's any variability, either in the number of shares or the amount of cash, boom. It's not equity. It gets classified as a financial asset or, more likely, a liability, debt. Even a tiny bit of uncertainty in that exchange flips the switch.
Wow. Okay, the source had a great illustration for this. Something about value.
Yes, exactly. If a contract requires the company to deliver enough of its own shares to equal a certain value, say, $100 worth of shares.
Right, instead of saying 10 shares.
Exactly. From the holder's point of view, getting $100 cash or $100 worth of shares feels the same, right? They're indifferent because the value is fixed, but the number of shares needed to meet that value could change. That contract is treated as debt.
So fixing the value, not the number of shares, makes it debt. That's subtle but huge. A company could think they're issuing equity, but because they promised a fixed value, they actually created a liability.
It's a classic trap, and there are other things, the source flags, that can push an instrument towards being debt.
Okay, like what?
Well, is redemption up to the holder? If the holder can demand their cash back, that creates an obligation for the issuer.
Makes sense.
Does the instrument have a limited life? Or is redemption triggered by some future uncertain event that neither side controls? Or another big one, are the dividends non-discretionary? Meaning the company has to pay them.
Got it. And on the flip side, what points strongly towards equity?
That's more straightforward, usually. Are the shares non-redeemable? So the company never has to buy them back. Is there no end date, no liquidation date for the instrument? And crucially, are dividends totally discretionary? Can the company choose not to pay?
It all comes back to that obligation versus discretion idea.
Pretty much. And generally, the classification follows this principle of substance over form.
Meaning, look at what it really is, not just what it's called.
Exactly. You look at the economic reality. A preference share might be called a share, but if it behaves like debt, say mandatory redemption, it's treated as debt for accounting. Substance over form. Now, like any rule, there are a couple of very technical exceptions the source mentions. Certain puttable instruments where the holder can force a buyback, and some obligations that only arise if the company liquidates. They're quite specific edge cases.
Right.
And it's worth remembering some instruments are deliberately structured to hit certain tax or accounting targets, which can make figuring out their true substance, quite tricky.
And here's a really practical point the source makes. You classify it when it's first issued, right? And then you stick with it.
That's absolutely critical. The classification is made at initial recognition, and it doesn't change just because circumstances change later.
So that redeemable preference share example, where the holder can ask for their money back.
Yeah. That's accounted for as debt from day one, even if legally it's called a share. The substance is that right to demand cash, so it's debt. And it stays debt, even if the holder never actually asks for the cash, or if the company's finances improve or worsen.
That really locks in the substance over form at the start.
So just when you think the main rules are sorted, there are always a few special cases.
Always. Let's talk about rights issues first. The source mentions an exception there.
Yes, rights issues. They can sometimes still be equity, even if the exercise price isn't in the company's main functional currency.
Hold on. Wouldn't currency fluctuation mean the fixed for fixed rule we talked about is broken? Variable cash amount, potentially.
Logically, yes. It seems like it would violate fixed for fixed. But this is a specific exception. It typically applies if a company is listed in different countries, or if laws require them to offer the rights issue in another currency.
Practical reasons.
Exactly. The standard basically acknowledges that forcing these into debt classification just because of currency rules needed for practical or legal reasons would be, well, unhelpful. So in these limited cases, the equity nature wins out over the strict fixed-for-fixed test due to currency.
That makes practical sense. Okay, what about instruments that seem like a mix? Part debt, part equity, all in one package, like a convertible bond.
Yes, compound instruments. A classic example is a convertible bond. It pays interest, that's a debt feature.
Right.
But it also gives the holder the option to swap it for a fixed number of the company's shares that's an equity feature.
So how do you account for that mishmash?
You use something called split accounting. When the instrument is first issued, you take the total cash received and you basically split it. You allocate it between the liability part and the equity part.
How do you figure out the split?
First, you figure out the value of the liability component. You measure it at the fair value of a similar bond that doesn't have the conversion option, so just the plain debt part.
Okay, the value of the chocolate bar without the lottery ticket, using your analogy.
Exactly. You value the bond part first. Then, the equity component, the conversion option, the lottery ticket, simply gets whatever value is left over from the total cash received. It's the residual amount.
Interesting. So you calculate the debt bit first, and equity is just the rest.
That's the process.
So wrapping this up, it's clear that telling debt and equity apart is way more complicated than it looks, but it's so important for understanding a company's finances.
Absolutely.
Tiny details in how an instrument is structured can completely change its classification. And that ripples through everything: gearing, profits, ability to get loans.
It really does. Anyone looking at financial statements or any manager thinking about raising funds needs to grasp these rules. It's not just semantics. It's about the underlying economic substance. I've definitely seen cases where something looked like equity on paper, but the accounting rules correctly flagged it as debt based on its actual terms.
It really highlights that substance over form idea again. Okay, so final thought for you, our listener. Given how nuanced this all is, think about financial products or maybe company structures you see in the news. Could any of them, applying this substance over form principle, actually be classified differently than their name suggests? And what might that tell you about their real nature? Something to chew on.